Welcome Piers Bolger is Head of Research and Investment at UBS. Let's take a look at the Australian Share Fund, but before we do that, let's take stock of the currently volatile environment. The Australian economy is being battered left, right and centre, but what's your prognosis of the market outlook?
Well, the market outlook, Peter, in our view, remains quite challenging. Certainly if you look at the global backdrop, whether it be the US, Europe or even Japan, our major trading partners are all in a recessionary environment, and it's certainly unlikely that Australia will avoid a recession in the near term. Therefore, for financial markets, they're likely to remain challenged over the next 6 to 9 months, particularly as the economy starts to bottom, and we don't expect the economy to bottom until really the first half of 2010. One of the great advantages of financial markets, to the extent, is that they try and look through the economic cycle. So in that respect, we think that certainly if all the bad news has come by the first half of next year, then markets should see some pickup potentially by the back end of this year.
We're now at the point where the US government has literally poured trillions of dollars into the US economy in an attempt to rescue it. How does that situation temper your decision making?
A little bit. Unfortunately, it's only occurring at the margins. We have seen credit spreads fall, but unfortunately you get some bad news and credit spreads also tend to move out quite quickly. At the moment, if you're looking more broadly at the market level, credit spreads are still extremely high relative to what you would expect in a normal, more stable environment. So in that respect, we do expect credit spreads to fall, but that will only occur once we see liquidity and the financial issues that are currently facing both the US and other global economies start to stabilise. And that really will take time, whether it be further impetus from regulators or whether it be further monetary or fiscal impetus from central governments and financial banks.
The view is firmly is that nothing is going to happen to restoring the financial system to health until all the toxic assets are off the balance sheets of US banks. In your opinion, though, just how big a challenge is this for Barack Obama?
Oh, it's an enormous challenge, not only for the US administration, but for the UK as well, and certainly for the rest of Europe. You could argue actually that the UK is actually in a worse situation than potentially what the US has been, simply on the basis that the US has certainly to date been quite aggressive in terms of trying to solve or provide some solutions to the problems they're facing. Unfortunately, there's no easy answer, and one of the biggest issues about a lot of the toxic debt that you're talking about is the pricing of that debt in order for us to enable investors and institutions to adequately deliver on trying to solve a lot of the problems that we're currently facing at the moment.
Now, these are all global issues, but the Australian Share Fund comprises mostly domestic equities. What's the investment strategy of the fund?
The investment strategy principally is to invest in high quality, domestically listed companies on the Australian Stock Exchange. The focus of the portfolio tends to focus on the top 100 companies by market capitalisation, so you're talking very familiar household names. As an investment strategy, we aim to deliver consistent long-term performance with an aim of trying to beat the investment market by roughly 2 to 3% over a 3 to 5 year investment time horizon.
Have any particular shares had reputational damage over the last year or so as a result of the market conditions?
Well, one of the great things about our investment process is that we tend to avoid a lot of those, what you'd probably say, spivvy or highly leveraged or financially engineered types of companies. Our focus from an investment perspective is on cash flow and free cash flow. Our valuation approach is such that we believe the fundamental value of a company is based upon the present value of its future cash flows. One of the biggest problems that we've seen in financial markets, not only here in Australia but certainly offshore, has been the use of leverage to artificially improve the performance of companies right across the market cycle. The way that we think about investing is to really strip out that level of leverage. So from our perspective, we've actually avoided many of those companies, in fact all of those companies, in that context.
So what shares have been the best performers so far?
Well, the best performers for the portfolio certainly over the medium term, because I think when you look at investing in equities, you need to focus on that medium term horizon, has been companies such as QBE, Lion Nathan, Woolworths, Sonic Healthcare, Rio Tinto. So certainly very strong household names. More recently, we've introduced positions, overweight positions in the portfolio to the financial sector, because we believe certainly domestic banks are in a very good shape relative to their peers offshore, as well as companies such as Toll and Brambles, which have a fantastic position in the logistics side of the Australian economy.
What's the maximum number of holdings in each portfolio?
Portfolio tends to invest between 30 to 60 companies on the exchange. Currently at the moment we're roughly around about 40 to 42 companies invested in the portfolio.
And how has the fund been performing since its inception?
Fund has performed very well, in line with what we would expect. As I said earlier, we try to deliver an investment performance 2 to 3% above the market over the long term, and the fund's been running now for just over 13 years. We've delivered roughly around about a 2.5% return above the market over that entire period.
How do you balance your weightings in each sector, and which sector do you expect to perform the best over the next 12 months?
The way that we look at constructing the portfolio is actually based upon fundamental bottom-up analysis. So rather than try and identify sectors or particular market points, market cycles in which to invest, we really look at individual companies. So our sector's exposures are actually a fallout of the bottom-up research. That said, as I was saying earlier, we certainly believe that the banks and non-bank financials are quite attractive. So we have overweight positions in all the major banks, and we also have positions in QBE, AMP and Macquarie Bank as well. We think they are certainly well positioned relative to their peers, and in a market sense have clearly been discounted quite severely in our view. We also have overweight positions in some high quality industrials such as Toll and Brambles, as I was mentioning earlier, and companies such as Harvey Norman, which even in this environment where credit growth has slowed and discretionary retail has declined quite severely, companies such as Harvey Norman are very well positioned not only to take advantage and ride through this cycle, but actually increase their market share. So the focus from our end is very much on high quality businesses that have strong monopoly franchises, quality management and importantly free cash flow.
Are you feeling confident that all the bad news is now out for the banks?
In our view, we certainly believe that the news in a major sense is out. One of the biggest risks to the banking environment here in the Australian context is clearly if we see a significant uptick in unemployment, and we do expect unemployment to probably hit roughly 7% by the end of the bottom of the economic cycle. So the issue is obviously bad debt on the housing side of it. But certainly in terms of the provisioning, the banks have increased their capital ratios, and we certainly don't see that it's going to have a significant negative impact on the financial sector over the next 12 to 18 months.
We've seen some companies recently cut back on their dividends, something that would upset some investors. Has that changed the way that you manage the fund at all?
Certainly we believe that that's appropriate capital management. If you look at the banks and you look at other corporates that are simply trying to either deleverage their own balance sheets or ensure they've got enough capital on their balance sheet to manage through this financial crisis, we think it's an appropriate way to manage a business. So in our perspective, having seen the banks and other corporates actually decrease their dividends in more recent times, in our view, is actually quite a positive attribution, because it means they're focusing on sustainability of their business. No corporate has actually indicated that they're going to maintain lower dividends once they move through the cycle, and we think that that's an important element for people to realise.
So finally, the big question, are you a bull or a bear when it comes to predicting recovery over the next 12 months?
Well, as I was saying earlier, clearly we're going through a very difficult environment at this point in time, and we don't expect the economic cycle really to bottom until the second half of 2010. So within that context, we wouldn't expect financial markets to really pick up until the back end of this year at the earliest, and probably not until we see the bottoming of the economic cycle through the first half of 2010.